Evening, everyone. A very warm welcome to all of you today for today's webinar on deposits and loan under the Companies Act 2013. We are delighted to have you all with us for this focus session and practical insights. It is our pleasure to extend a warm welcome to our chairman, Sir C. Babu Ibrahim, in absentia, our vice chairperson, C. Preeti Savla Madam, and today's esteemed speaker, C. Baby Paul Sir, and our esteemed moderator for the session, C. Srinivasan PR. We are honored to have all of you with us today. I would now request our chairman, sir, to kindly address the participant and formally open the session.
Very good evening to various participants joined across the country. My throat is not all right, therefore my voice, my apology that my voice won't be appropriate. Welcome to the distinguished speaker of the day, CA Baby Paul, one of the very outstanding professional and who is heading the large corporate practice at Cochin and who has got nearly 3 decades of experience in the corporate audit, joined by P.R. Srinivasan, who is the past chairman of the Ernakulam branch, and also auditors for listed entities. Today we are going to discuss on one of the most important topic on the deposits, public deposits and corporate deposits, which is a very, I would say, people get into difficulty unknowingly. This is one area where professionals and corporates get into difficulty unknowingly. Therefore, I think we are going to discuss on some of the key important areas. I'm sure the moderator and the speaker will put in thoughts to enlighten us today. Over to Seema, the Secretary, Corporate Law and Corporate Governance Committee.
Thank you so much, sir, for your engaging words. I would now like to request our moderator, C. Srinivasan PR, sir, who is a chartered accountant and an insolvency professional registered with IBBI, practicing since 2003. He has a wide experience in audit, forensic audit, taxation, and insolvency resolution, and has held several leadership roles, including chairman of the Ernakulam branch of SIRC. Sir, I request you to kindly introduce our esteemed speaker, C. Baby Paul, sir, for this session. Over to you, sir. Thank you.
Thank you so much, madam, for that wonderful introduction. Very good evening to all my fellow professionals from across the country. I think the topic of deposits and loans of the Companies Act is one area perhaps where law, finance, compliance, and judgment intersect very sharply. At the first glance, deposits and loans appear to be very simple funding transactions, money received and money given, as simple as that. But as we all know, under Companies Act, the nomenclature doesn't matter. The substance does matter. One of the most litigated and non-compliant areas in corporate law is, as our chairman, Sir C. Babu Ibrahim Kallivel, correctly mentioned, unintended classification of a transaction as deposit. Many companies believe they have taken a loan until Section 73 or 76, read with the Acceptance of Deposit Rules 2014, tells a different story altogether. As chartered accountants and as auditors, we often encounter these issues everywhere. Acceptance of funds from directors, relatives, shareholders, group entities, intercorporate loans and deposits, advances, security deposits, unsecured loans, all of which can change color depending upon the structure, disclosures, and the timing. On the other hand, Section 185 and 186 of the Companies Act, again dealing with loans, guarantees, and investments, they are not just technical provisions. I would look at them as governance provisions aimed at preventing misuse of corporate funds, especially in closely held group corporates. What makes this topic critical is that non-compliance has serious consequences. The transactions may be void or repayable immediately. It can trigger heavy penalties, and in some cases, personal liabilities on the directors too. Therefore, dear friends, today's session is not just about knowing the law, but about knowing the correct classification, proper documentation, the board and shareholder approval mechanisms, and most importantly, how we as chartered accountants and auditors can help our clients proactively and prevent them from walking into avoidable violations, litigations, and issues. I'm sure this session will help us not only refresh fundamentals, but I'm sure our speaker, CA Baby Paul, will take us through the nitty-gritties, the complexities, and the consequences, and also give us some very important advices and tips on this particular subject. With these words, I am delighted to invite our speaker for the day. He has over 19 years of experience in serving leading companies in healthcare, financial services, consumer markets, and manufacturing. He has vast experience in audit of large and multinational companies coming under different frameworks such as Ind AS, IFRS, IGAP, etc. He carries significant experience in IPOs and also right issue engagements. He is a highly sought after trainer, both within his organization, within ICEI, and outside in technical matters. So I'm sure we will have a very engaging session today. With these few words, let me introduce CA Baby Paul, partner BSR and Associates LLP, to go ahead with the session. Sir, it's over to you now, sir.
Yeah, hi. So I think I can't switch on the video. It is disabled by the host. Can you, Srishti or Seema? Yeah. Yeah, Sri, can you hear me? Better?
Yes, we can hear you, sir.
Okay, okay. So, thank you, Srinivas. I think broadly it is set up very well. How do I say? Maybe this act is implemented a decade back. Maybe this is the 11th year into the practice. All of us gone through most of the nitty-gritties. So I don't think anyone not aware about all this thing. But I thought this will be a good refresher for all of us, considering every year we encounter new things. So this is a good start to go through. And this is one of the sessions or one of two different areas where most of the companies are impacted or attracted. I'm just sharing my presentation as well. Give me a second. Yeah, is it the actual is it full screen view now? Yeah, okay. Thank you. So yeah, so basically then I kind of split it into two divisions rather. One, we'll start with deposit section first, then we'll go to the loans. As he mentioned, deposits is a, how do I put it? And every company will have something or other which will come in the ambit of deposits. And it's all start with section 73 to 76 of the Act and include both deposit rules, which is 2014. So effectively, this is, as I said, it's 11th year into running the entire Act and rules. So why this is so important? Because deposits, the way it is defined under Companies Act is not really the deposit. They just say that it is any receipt of money. So if you go to the balance sheet and the liability side, unless it is specifically excluded, everything can get into a color of deposits, because it doesn't say that this is deposit, that is deposit. Just say that any receipt of money, unless it is specifically excluded. All right. So that, and then we will go through the exclusion. So we need to be very careful. All the captions on the liability side, any of these can get into deposit. Now, other than so for example, there is 73(2) plus 76 gives a lot of companies or classified certain companies who can actually collect deposits. It is called as eligible company. So to go to that definition, broadly, it should be a public company. It should have a net worth of 100 crore or turnover of 500 crores. So unless you are categorized into a eligible company, as I said, eligible company should have these criteria. Of course, they need to go through the ROC and RBI approvals, etc., before they get into deposits. Every other company cannot accept any money as deposits, right? Now we'll go through the way Srinivas explained in the beginning, what could potentially be a deposits even in a normal circumstances. So how does the section work? So as I said, 73 to 76, 73 is where I think they report back to the acceptance of deposit rule. Deposit rule primarily 2(1)(c), where it is given all the exceptions which is not considered as deposits. So I'll start with the common things which we all encounter in our most of our companies, right? One is the share application money. In a general scenario, share application money should not be deposits, but the way the act or rule says that if the money received and not allotted within 60 days. So all of us will recollect, right? In the past, if there is an urgent requirement of money, the promoters or the shareholders or members bring some money as application money, and we take few time to kind of allot that into shares. So during those times, it is being used for the purpose of business. Now they said no, boss. You need to look at each of these share application money and with a limitation in time, right? 60 days you should allot, and after 60 days not allotted, another 15 days is there to refund that money, and it is refund, right? It can't be adjusted with any other receivable payable. Once we received our share application money, 60 days, so effectively 75 days. Within 75 days, this need to be refunded back to the shareholders. If it is not refunded, then you come under the bracket of deposits. And once you in the bracket of deposits, as you know, there are quite a few other regulations or rules or liabilities come into picture, right? So need to be very careful across companies. This is, and the liability clause that we explained in the beginning, right? It is applicable for the company, applicable for the directors in their personal capacities, right? So this is one of the key area which at times we keep missing. That 75-day cutoff need to be kept in mind. Just to reiterate, at time we will say that there is some receivable from the same shareholder or member, etc. Can we adjust that against it? No adjustment of share application money in any form is allowed. It need to be refunded back within 75 days. Right. This is one of the first one I would want to cover. Now, there are certain other exemptions. If this is if you are a company which has transaction from outside India, it could be amount received from an NRI, etc. So any money received from, this is common, right? Any money received from outside India, Companies Act or deposit rules says that it is not part of the deposit rules. It will be dealt by FEMA, and because there is a separate regulation available, they said it will be dealt by other regulation, not by Companies Act. So it's completely excluded from deposit rules. Just to ensure that we have how do I say, FEMA have its own restrictions, right? For example, if an advance received against any services or goods and it is outstanding for 1 year, then immediately you need to intimate the AD bank. And if it is exceeding 3 years, then it will be treated on ECB. And once you classify it again under ECB, it is actually more regulation than a Companies Act come into picture. You need to go to RBI. Unless the prior approval of RBI, this may not be even able to refund as well, right? So so advance in any form, whether it is from India, outside India, need to be careful if it is outstanding for a longer period. Outside India, 1 year plus 3 years. After 3 years, this is clearly a no kind of thing, and prior RBI approval is there. You would have seen 2 weeks back, there is a new circular or notification from RBI on these matters. There are some relaxation on this now. Instead of RBI, they are actually delegated some of this power to the AD bank, which is effective from 1st October 2026. It is still maybe 6-7 months away. But this is an important session if you have any such advances from outside India. But outside India advances generally excluded from the deposit rules. This is other than the normal advances, right? Normal advances in the beginning, again, Srinivasan mentioned, right? We just take it very easily. We get some advances and left it there. For example, to give you a perspective, if you're a vehicle dealer, right, you get a advance against the vehicle. He may deposit 1,000 rupees or 10,000 rupees to book a vehicle. After a period, he may either drop that vehicle plan, he may move to a new vehicle to purchase, so he just leave it as it is, that deposit. So it will be with the dealer or that company for that matter. Other thing is, we have a lot of these schemes run by jewelry companies or other companies, right? Where advance being collected, and if there is a scheme like if you pay regularly for 12 months, you get an additional 1 month kind of schemes, right? There are quite a few such schemes which is running as advance from customers. We all need to be very careful. Look at the aging report of these advances. If any of these advances is outstanding for a period of 1 year from the date of receipt, it is again classified as deposits. So, so as I said, every company can have this kind of situation, right? So advance from customers is a very common thing, and it is there in most of these companies, the vehicle dealers, jewelry companies, hospitals, right? These are all wherever the people have a lot of customers involved, etc. Even your the Swiggies or Zomatos, etc. People pay a lot of advances, then later adjust against future invoices. So just be very careful. This is 365 days is what maximum an advance can be kept in the books of account. After that, it should be refunded. Otherwise, it is classified as deposits. I need to be reported under DPT3 on an every annual period. But below 365 days, it is excluded. That's the exclusion primarily. Now, if any advances received against immovable property, for example, if you're a real estate company, of course, that advance being not knocked off in a year's time. So there is if it is a immovable property, of course, that as per the agreement, if it is taking 3 years, that is allowed. So the earlier 365 days applies only for the general goods and services. Immovable property and capital goods is specifically excluded, but the agreement need to be specifically mentioned what period they are expected to deliver. So that way, capital goods and immovable properties are excluded. Now, security deposit, right? Security deposit, any random security deposit cannot be collected. But if there is a contract, and as per the contract, the company is eligible to collect certain amount of security deposit, and that which is as per the agreement, then security deposit is excluded. So, for example, if you have a rent deposit, which is generally not considered as deposits that way, right? I mean, which is or electricity deposit or that kind of company, if you collect anything, or a real estate company collecting any caution deposit initially for the R&M, etc. So those are anyway excluded. Now, another common thing is people do collect amounts against warranty and maintenance contract. This will be there for maybe if you're an equipment manufacturer or a vehicle OEM or any type of, or at times if you're a service providing company, they may say that performance for a warranty for a period of 5 years, etc. So that is also excluded from deposits rules. The only condition is that this period should be in line with common industry practice or common business practice, the way they say, or a period of 5 years. So what they're restricting to do is that don't collect as a warranty advance, etc. for a period of beyond 5 years. Generally, for example, the industry say that generally for 3 years, so you can't collect ideally for more than 3 years. But maybe 3 to 5 years also considered as a acceptable range, but beyond 5 years, no early collection. Why all this being done? I mean, all of us would know, right? People are just collecting money and utilizing this for the business purpose. So government said, no, boss, you don't use any public money, etc. For any purpose. So use it on your own fund. So that's the reason they kept all this caveats or conditions against all of this. This is the common thing we all may be doing as well, right? We take subscriptions, etc., which is, for example, if there is a 3-year OTT subscription, which is allowed, right? I mean, if it as per the regular this thing, so subscriptions to newspaper, journals, all that is allowed, which is even if it is an advance. Now, these are the common advances which is excluded in terms of in terms of as per the company's this thing. One caveat towards the last deposit rule says that, for example, you are supposed to get an approval for collecting these advances, and the approval not came in place, right? then there is no period of 1 year or 3 year or 5 year, which is we shown in the earlier slides. Actually, if the approval has not come, then 15 days time. If the approval has not come, then 15 days need to be refunded. To give you an example, for example, if PVR or Rhinox collected advance against movies, right? At time they collect advance booking, etc., and the movie itself is not approved to screen for a week. I mean, there are quite a few such instances, right? Then that refund, that money, they cannot keep it for long. So maximum period is 15 days. They need to immediately refund. That's the regulation. So if there is an approval pending and you keep collected money, it should be immediately refunded. So all this is, I mean, if you are moved out to the cutoff, then all will fall back to deposits. But otherwise, on all these are common in most of our companies. If you are within the ambit of all this, none of these are deposits. So that's how we should also look at other way around, right? So these are excluded as well. Moving on, the other category of exceptions given is that, so if you're a promoter of a group, I mean, promoter is again widely used, and there could be very different opinion who is a promoter, who is not. But if it is a promoter is giving, supposed to give certain money based on the agreement of the lending institution, then that money is not considered as deposit, because if the lender wanted that money to be paid by the promoter, then it is for that purpose, or not to be deposited. But it's very common. I mean, saying if the promoter is giving money, ideally should not be deposit, but it's just calling out. Only thing is, no, this exception is only available until this loan is repaid. After that, this money also repaid back to the promoter. Or if it is a member, then private company, etc., we have a separate regulation. So it's separate exemption anyway. But in a general scenario, if this money came because of the lender agreement, then this money to be repaid back once that loan is also closed. That's expectation here. Now, another very, very, very common example which we have, loan from directors, which is what generally the directors or the shareholders used to get the money. Loans to directors, and so, I mean, if you look back when the rules came initially from 1st April 2024, even this was restricted. The earlier Companies Act 1956, this was allowed, but 2013 this was restricted. But over a period, they said, I mean, it is okay, right? I mean, directors and its relatives paying money to the company, it's still fine. So they kind of relaxed this provision. So anything comes from loan from director or relative is fine. The caveat is that, yeah, so it should be, I mean, when the money is received, at the time of receipt of money, the person should be a director, right? I mean, so I mean, for example, he should not be just a member, and you can't collect from the relative. So if he's a director and director at the point of receipt of money, then it is exempted. That's the provision. Now so the condition in the act is again is that, yes, you collect money from the director, but director cannot borrow from outside and give it to the company. So how the companies, I mean, if you're doing an audit of a company, or if you're a CFO of a company and we want it immediately, and director says, no, I can fund it. How the company need to do the compliances is that we should get a declaration from the director saying that this amount is not borrowed from anywhere. It is my own money. So this declaration is an integral documentation for the company as well as for the auditor, right? If there is a loan, and which is very common, and I don't think I mean, all of us are auditors for most of these companies, or we are at the finance side on all these companies. We generally miss to take these declarations from the directors, but very important documentation for us as well. And this is not for no exclusion, right? I mean, where it is small, big, no exclusion for any of the companies. So declaration, and people will ask us, how detailed should be the declaration, etc. But declaration can be very, very, very brief as well. You need to say that, no, I am not taking this money from anybody else, right? I mean, it is my own money. You don't need to show this. So next question is, do the director need to show the source of fund? No, I mean, there is no requirement to source of fund. I mean, as a company, you need to give a declaration, and the company need to believe on that. As an auditor, again, I mean, the auditor can rely on that declaration given by the directors. But it is an important documentation for everyone to do. Yeah, so only thing is this exemption is available only to the private companies, not to any other company, right? This not to public company. But if you look at the statistics, I mean, 96% of our companies are private companies, so it is widely available to all the companies. So generally exemptions, this is available to only private company. Limits is between 179 and 180, where 180 is how much you can take, borrow, etc. Right? 181C, the powers of the board, right? How much you can borrow. That's what they're referring here. But this is an acceptable provision which is available to all private limited companies. See, so there are ways and means to collect money from directors, relatives, members, everyone, right? The only thing is ensure we are falling in the ambit of these parameters. Once we fall in the ambit of parameters, I mean, then there is no challenge of deposit rules, etc., applicable to the company. Again, now, so that is directors. Now, if it is a private limited company, what will happen to the shareholders, right? I mean, because directors could be 2 people, there could be another maybe 15, 20 people as shareholders. So now, can we take shareholder loans? Of course, yes, right? There are certain restrictions are there. However, shareholder loans are there. Now, first category of private limited companies is that now all of you know, right? SMC versus non-SMC companies, right? The small company, not SMC, small company versus non companies. Now, most of the companies are, or rather can fall under small company. You would have read the recent notification where the limit is now gone up from paid up capital of 10 crores to turnover of 100 crores. So it all started with 1 crore small company. Now it is paid up capital of 10 crores or turnover of 100 crores. So most of the companies in India now will fall under small company. So if it is a small company, then these exemptions are actually available. Why this section again calling out? Because this company is in this case, company could be if it is an associate or a subsidiary company, right? Then you are out of the small company definition. So if it is an associate subsidiary company, then you are out of a small company. So if it is not a small company, they are saying these are the restriction available. One is if there is a borrowing, usually in a borrowing sanction letter, the bank itself will tell, right? I mean, there are certain restrictions will be there to take loans or give loans, etc. So that will be there. And if there's a default against any of this borrowing, and default, we need to be careful. Default is, if there's a CARO applicability, then defaulters will be reported. But if there's a default, even in a single day in the repayment of principal or interest, it is considered as default. Then we need to go to that lending institution and to take a waiver, etc. So otherwise, we will not be able to take any such loan from shareholders. A lot of people actually, I mean, I don't want to say lot, but there are some of the promoters or companies actually using this provision to collect money because number of shareholders can be a little bigger, right? So they will be just a shareholder, but that they keep pumping money to the company as unsecured loans, right, with a good interest rate, etc. So this could be potentially this thing, but ensure that it is not going beyond twice of the paid up share capital or 50 crore, and if the loan is not more than that kind of thing, right? So this is an exception available. Now again, if it is not falling on the previous criteria, so this is the last criteria is primarily the small companies, right? Small companies can accept deposit or loan from shareholders up to 100% of their paid up capital and free reserve. So which is allowed. So any private company for that matter can accept up to 100% of the share capital reserve if they are not falling in the small company criteria. Okay. So this is again, I mean, very, very good relaxation. I mean, all of us will recollect if this relaxation actually was not there when it is implemented. Over a period, this relaxation has come, but relaxation also have certain conditions. So we should ensure companies actually comply with these relaxations as well. Now moving on to this is another. I mean, this is the latest theme. Again, came up maybe India catching up to the startup environment. So startup entities actually said, I mean, they need more relaxation than the regular private companies need, right? And so they went to the department, etc. So there is certain exemption, further extension actually given to startup entities. So what is a startup, right? I mean, startup need to be, there is no registration, etc. required, but broadly they're saying that startup should be a private entity. The first category it should be a private company. Second is the startup company should not be older than 10 years. So maximum period one company can be called a startup is only 10 years. There could be some companies even after 10 years may not have developed their product or may not get into that stage, etc. But cap from a startup perspective is only 10 years. The other condition is that any company which is incorporated is not a startup, right? They should have been developing something new. That's how the department saying the conditions are there. So some innovative technology, either in product or services, etc. So if you are a startup entity, there are further extensions. So as I said, the notification says that up to period of 10 years or for example, a startup entity within 10 years exceeded the turnover 100 crore, then they are out of startup, right? I mean, 100 crore turnover company regularly not considered as a startup. So if you meet all this criteria, we shown the previous slide, right, where you have only 100% of your capital can be, and maximum limit to accept loans or deposits up to 100%. That limit is again not applicable to them. So basically these companies actually can accept more money from its members. It can be 200% or 300% kind of thing. But to ensure that only this is applicable to startup companies, roughly out of 90 to 20 lakh companies, maybe 2 to 2.5 lakhs is considered as still startup companies. So maybe those companies still can accept without any such limits, and will not come under deposit rules. Now, so which is from the members, right? And startup companies actually need more money. I mean, because the members or shareholders may not be able to support the entire funding. So they said, okay, I mean, and some of the angel investors or venture capital funds, etc., invest into these companies through convertible note. Convertible note is, I mean, you issue an instrument which is later converted into equity. So which is the common investment theme in startup. So government said, okay, I mean, if somebody is investing 25 lakhs or more, not less, right? If somebody is investing 25 lakh or more, and it is within 10-year period, either convertible or repayable, then that is also not considered as deposits, right? So startup entities have a little more relaxation, which is the theme of the government as well. Yeah, broadly, this is for the startup company perspective. Now, I mean, as I said in the beginning, right? I mean, this is any amount in the liability side of the balance sheet is considered as deposit. That's how we started, and there are certain items which we gone through individually. Now, other exemptions, which is common. I mean, any logic suggests that these are not deposits, right? So they said if you have any money received from government, not a deposit, which could be a government grant or a loan from government, etc., etc. So, and loan from financial institution, bank, including commercial paper, etc., not a deposit, which is very common. Not want to spend too much of time. Bond debentures, nidhi companies, chit companies, and if you're using a scheme of which is approved by SEBI, all these are very common, and I don't think we'll have any doubt to say that these are deposits. So, which is widely excluded from a deposit rule perspective. This is another clause is given, but I need to be very careful. So, for example, they're saying that if you received a deposit from your employees and which is actually excluded from based on the employment contract, you collected some 10,000 rupees, etc., then it is excluded from the deposit rule. But we need to be very careful. There are other labor law related restrictions to collect deposit from the employees. For example, there can't be any, how do I say, for example, in hospitals, etc., nurses, you can't tell them to say that there is a bond to be given with an amount, etc. All that is restricted under labor laws. So maximum in maybe one can think through is that there could be some caution deposit, a marginal caution deposit or a hostel deposit, right? Some of this can be, and this could be part of their employment contract. Beyond that, this is clearly a no. But one is Companies Act, but we need to be looking at the other laws, especially the labor related laws. So even though it is excluded, we need to be very careful if you collect any money from employees as security deposit. The other one is intercorporate deposits. So intercorporate deposits is primarily which will cover in the section 185 and 186. Why they excluded here? Because it is covered anyway there. Both borrower and lender is covered under section 185 and 186. So they said, okay, there is no requirement to cover under section 73. So if it is an intercorporate deposit, then it is not come under deposits under section 73. So the last one, held under trust. So some people will say that no, I have certain money. This I was told to keep for the time being, and I need to refund back, etc. I'm just held under trust this particular amount. We need to be very vigilant. What is this held under trust is? So, if, for example, if the department given some refund and they said that this will be disputed, etc., then keeping that money is fine, but don't collect anything from the public or other than what is permitted in our earlier slides. So one or two examples to put it. For example, some hospitals, right? So hospitals, what will happen is you need to now these days without advance, you won't even get an admission, right? Hospitals generally need an admission advance to get an admission. So at times, what happens? So if there is an insurance claim, etc., they collect advance, and even if it is after a point, then maybe the customer or the patient will not come back. And what the hospitals do, they keep it in there. I mean, they don't write it back, but they keep it in their books of account to say that payable to the patient when they come back. And some of these guys are actually say that this is held under trust until the patient comes back. But this advance, so patient end of the day for a hospital is a customer, so it will not come here. We need to refer back to that advance from customers definition which we spoke earlier. So if it is anything related to a customer, then advance which is beyond a period of 365 days is not acceptable. So yeah, both at the company and the auditor need to be very careful when we look at the advances side of the balance sheet. This is primarily most of the exemptions to say. Yeah. Now from here, I mean, 73(2) plus the 76 is where the companies which is really can take deposits, right? I mean, but it is little. I mean, if you really want to take deposits, etc., beyond what we discussed and exemptions, then the regulation or the requirement is much bigger. I mean, to give you a perspective, for example, you may need a credit rating to be done, your circulars, advertisement, etc., to be right. I mean, filed with ROC, interest rate, brokerage, all that is regulated. You need to go to RBI for many of these approvals, and there is a deposit insurance mandatory. And if you're an auditor, I mean, if you end up having in situation like this, then the deposit reserve, right, which is to be also created. So, but when we were looking some statistics of how many companies could fall into this category. This is a very limited number of companies to give you perspective, right? So if any of our clients or if you're working in a company and any of these companies are falling under this, of course, need to be more vigilant. It is not an easy task that way. So should be looked at more detail. I mean, because the regulations or compliance requirements are more cumbersome to give you a perspective. Yeah. Next is this is again DPT3, right? I mean, see, we've gone through what could be a potential deposits, right? Potential deposits, to give you an example, for example, if the share application money received, we couldn't allot the shares on 60 days and another 15 days pass, couldn't refund, then it is a deposit, right? And then once it is falling into deposits and this DPT3, whether it is need to be mandatorily filed. So DPT3, that form, I think there are 4 radio buttons if somebody need to go through. So this due date is generally end of June, not after our audit period. Because audit generally getting done, or because the timelines are September, right? I mean, but DPT3 to be filed somewhere in June. So if any of those which we discussed earlier and we couldn't comply, then this return will come into picture. And this is, I mean, I was talking about a couple of exemptions for the in the previous slide. When you look at the limits of the amounts received from directors, relatives, etc. But here, no exemption to file DPT3 for any companies, right? Everybody. So if there are active companies of 90 lakh in India, all 90 lakh companies to file, even if it is a nil one, right? So there are some. I mean, if you speak to some of the people, what we understand, people consider it, if deposits are not there in the company, this form is not mandatory. But if you look at some of the ROC FAQs, they were very clear, DPT3 to be filed. And because most of the companies will have one of these item, like an advance from customer. See, if you don't have any item and which is falling under that acceptance or deposit rule, then not required to be filed. For example, you have an advance, right? And advance from customers, which is settled within 365 days. This is an exclusion given in 2(1)(c). So if it is advance received, it's settled within 365 days, they said that they not deposit, but it is an exclusion given in 2(1)(c) of the deposit rule. That need to be filed through this return, which is the radio button. I mean, if you go open the document, there's a radio button. So the item number 3 is what we capture all this. So ensure that DPT3 is filed. And as I said earlier, DPT3 is not filed after the audit report filing. It is 30th June unless it is extended in any particular year. Ensure that we file this. There are instances where it is not filed and there are notices coming, etc. See, these days it is for ROC, it is very easy, right? Very easy to figure out who filed, who not filed, etc. So be careful. So as I said, we had discussed certain exemptions in the deposit rule. The item number, all this exemption to be filed under radio button number 3, which is to read that transaction not considered a deposit. There you need to give all these amounts. Now, next question is there auditor certificate mandatory on DPT3, right? At least if all these are exempted deposit based on the deposit rule or section 73(1) or 2, if it is all items are exempted deposit, there is no mandatory requirement of an auditor certification. So, which is clear. So, auditor certification is not mandatory, which is, I think, clarified by various ROCs whenever we interacted. But the company need to file, right? But if you end up having any of these item which is coming into deposit because of when you haven't met those timelines, then auditor certificate is mandatory. So that is where the auditor will come into picture. And couldn't comply with any of these items, then auditor certificate is mandatory. I'm moving on. Now come back to, most of us will be hopefully, I know most of us are auditors of these companies, right? What is the auditor's responsibility in these items? One is management need to have detailed disclosures if any of these are there, and if you end up having any item as deposits, right? And you need to, it should clearly come out how much is the deposit, what is the interest rate charged, is there a security, is there a governance or compliance is mandatory, is there repayment terms, etc. But if it is only there is an item called deposits, but otherwise if none of them are deposits, then we don't give any disclosures on the financial statement. But then the auditor and the management need to ensure that none of these are deposit which is sitting in the liability side of the balance sheet, right? And if you have CARO reporting and any of these items are falling into that category, then there's a specific requirement to report under close file. To give you an example, for example, we have we have an item, and which is the management couldn't settle within 365 days, right? And management saying that no, this is not deposit. We will repay immediately after 365 days. Then, but as an auditor, we need to look at during the year. If it is exceeded, then we need to report, right? So there are languages given in guidance note. At least highlight the fact that there are certain items exceeded, but however, management can take a legal opinion or assessment, etc., and say that management is in the process of refunding, or to give a statement of fact. Don't leave it open if any of these items are actually in that category of deposits, right? So at times we take a lenient view, but I mean the suggestion being, if any of these items are there as deposits, please do report. At least, I mean, it may not be a negative reporting, or it may be a qualification. Considering there is a question in Caro, I mean, better to report a statement of fact. Yeah, that's it on the deposit side. Yeah, so deposits primarily, I think, primarily those are the. See, I mean, generally, when in our practical case, if you go back, I mean, one or two items keep coming back, is one of the advance from customers, no proper monitoring in most of the companies where it is exceeded 1 year. So that is one common item, at least personally in my I mean, experience, which we can figure out. People not looking at the aging reports, etc. So that is one item which is there. Second is this: whenever there's a share application money, we take it little lenient in terms of allotting the shares, or we're not refunding, etc., which could potentially be the one. The other one is that private company. It's a private company, it is allowed it, but then there are limits, right? The limits is there. So beyond that, at times, take the money, because see, some of this private company could be a loss-making company, and your paid up capital and free reserve may not be a large number, and they would give amounts which is bigger than that. Then we are into non-compliance, right? So those are 2-3 scenarios where generally we found missing kind of thing. Another example could be is that, see, as I said, maybe if the company received any money for any subscriptions, right? There is a subscription for a 2-year, and you have invoiced that to the customer. Then even if it is so, what the company will do? Company will only apportion that particular year revenue in that period. Remaining will be apportioned over a period of 2 years or 3 years. So some amount may be outstanding for a period of beyond 1 year. Those are accepted, right? Because it is provided against a particular invoice or a contract, etc. So that is allowed. And if there is any gray area in our company, which is the management challenging that no, this is not a deposit, even though it is beyond the limits, etc. As an auditor, the suggestion being, request the management to do an independent assessment through a legal guy and confirm that no, then we'll bring out the fact in our close 5 of Caro, right? That's how we should deal with it. Yeah, so primarily those are the items from a deposit perspective. Okay, I'm moving to the next one. So as I said, so I mean, between loans and deposit, most of the companies will have either a loan or a deposit, right? I mean, so and deposit, we saw quite a few restrictions to collect money. Now the other side of the balance sheet now, right? How do you give money to somebody else, which you are some way connected with, and connected with, because see, if it is given to an independent party, etc., there are certain restrictions as well. But if you are connected in any way manner, right? You have a common promoter group, or it is subsidiary, associate, or it is a related entity, etc., where these restrictions the government is bringing, and even after this, we can see a lot of people misutilize this money clearly. I mean, we would have seen that Blue Smart or that Cabwala company listed entity, right? They were directed this money through very recently, maybe 6-7 months back. They used the public money to move that money into multiple layers, and finally he bought a flat in flat in Gurgaon DLF kind of thing. So at times we think that no, this money is not given to any related party, so it is fine, and there is some interest also there. But as I said, the other side, if the liability side is gone through such a detailed analysis, then if you are having any loans or advances on the debit side of the balance sheet, look at very critically. Don't just conclude that no, this is not a related party, so it is fine to give loan, and I have enough fund, and I am earning an interest rate of more. See, I mean, and you would have again experience. Some of the companies actually come back and tell us, boss, I mean, I'm keeping this money in fixed deposit. I have an excess cash. I am keeping this money in fixed deposit or in money market instrument, right? The mutual funds, and that may give you in the range of 6 to 8%. I mean, generally that's a range of interest rate available. But then one guy, one of my, I mean, this is not a related entity, but one company came and asked me, I can give you 10% of interest. Give me that money. So then this director said, boss, I mean, why am I losing money? So I will give this money to the other party with 10% interest. Is that an allowed one? So government is saying, of course, listed company and its subsidiaries restricted more. But if it is your own company, private company, it's your own money, there is, I mean, you can give loan, right? So you can, of course, give loan, but there are some restrictions or documentation for that matter. But as an auditor, we should be very careful. These loans, nobody will give loan to somebody, right? And from this company and company side, if you see, if it is not in your ordinary course of business to give loans to somebody, then it is not acceptable. So we need to be very careful. I mean, we can still see loans running around in most of this group. And if it's generally, this is how it happens, right? We'll have one profitable company in the group, and this profitable companies supports the other companies in the group through these loans. So that's where all this getting into an issue. And so many, I mean, if you look back all these recent frauds or misutilization, whatever you say in the NAFRA reports, everything actually lead to that one line item which is called loans. So auditing loans is very, very, very important item. So again, I mean, we had 1956. There also these restrictions were there. So start with this section again start with very negatively, right? It actually prohibits. So they're saying no company shall is what the section starts, right? So actually section 185 actually say that no loan should be given. It actually prohibits to give any loan. From there, they said, okay, you have certain exemptions because of the business requirement. So we'll go through the exemption, but generally no loan cannot be given. All right. And that's how the section 185 is started. We have 186 where certain limits is being given, etc. to start, I mean, give loan, but 185 clearly say no loans to be given. Now, who are those parties from a loan perspective, right? It is a wide one. If you see anybody who is related to the company, right, director of the company, of the holding company, of the subsidiary company, relative, partner, I mean, and relative, you know, right? Relative definition in companies act is very wide. So then if it is a private company, then it should not be to a shareholder or a director. And if the body corporate mean any other company where the 25% is held by this company or a director, etc. So, or even if no directorship, the other board is accustomed to act on behalf of this board. For example, it's wholly owned subsidiaries or subsidiaries for that matter, or through an agreement, etc. So these are clearly prohibited. Of course, there are exceptions available, which we'll cover in the subsequent slide. But this particular session, we need to be careful. See, what is the other side which we initially spoke? The company collected money unless it is a very collecting through some misrepresented way, still okay. I mean, the ROC looking at very this thing. But this side, when you give a loan to misutilize for any purpose, then that's where I think ROC is more looking to each of these reports, etc. Now, of course, there are exceptions. So now we'll go through some of the exceptions anyway. So one exception, so if it's a group and there are wholly owned subsidiaries, right? Wholly owned subsidiaries and need to be wholly owned. I mean, wholly owned is again defined. Wholly owned is 100% owned by the parent. It can't be even 99%. Okay, so I need to be very careful because 99%, if it is held by the parent, then it is only 99%. Sorry, it is only a subsidiary, not a wholly owned subsidiary, right? So it should be a wholly owned subsidiary to get exempted. So any loan given, guarantee given, or security given, even to the bank, if the bank wanted a security for the loan given to the subsidiary, all that is exempted. So which is clearly an exemption. There are conditions, right? Conditions, of course, will be there even if it is given. So the first condition, I mean, we may look at very generic, but need to be careful. The loan should be given and that company should be utilized only for its principal business activity. So, for example, a parent cannot give to a wholly owned subsidiary a loan. They cannot acquire another company, or they cannot acquire or they cannot invest into another company. Maybe even if it is 5%, 10%, or they cannot give us a loan to another company. See, I mean, there are quite a few examples in the public domain, right? People give loan from this company to the next company, which will be generally a wholly owned subsidiary. And that's how the consolidation happen and get knocked off and console now impact, etc. Then from the wholly owned subsidiary, it will go to elsewhere. So this chain generally is where most of this fraud happen. So if it is not given to the principal business activity, then this is a violation. So it is again prohibited, right? So need to be very careful. Loan is given to the wholly owned subsidiary for its principal business activity. That company should not use for any other activity. And of course, wholly owned, even if it is wholly owned subsidiary, limits, right? Limits of 60% of your paid up capital plus free reserve plus 100% of that. I mean, I'll cover anyway subsequent slide. 196(2) limit still applicable. So since it is excluded from 185 doesn't mean that no limits is there. We can give any amount as loan. So limit is still applicable. So what is, see, so this is again a responsibility to the lending company as well as the borrowing company. Borrowing company is a wholly owned subsidiary. Borrowing company should ensure that the fund is obtained from the wholly owned, sorry, parent is only utilized for the principal business activity. Similarly, the other company. So there should be a declaration actually moving around between the holding company and subsidiary company. And documentation, I'll touch again little detail in the subsequent slide. All right. As an auditor, how do we do? Yeah. So anyway, limits will cover. See, one or two questions which usually comes is that you will take an approval to give loan, and if it is a approval is, for example, even if it is exceeding, you can take a special resolution approval. So special resolution again to be approved through a general meeting, which generally most of the companies will get, right? And they say that total amount of loan is, to give an example, maybe 1 crore. So what do they do is that they give 25 lakhs, take back 25 lakhs. So, I mean, because of fund requirement at subsidiary, it will come, they suddenly pump in 25 lakhs. They will repay that money. And so at any point in time, it may not exceed 1 crore. But if you need to really read through the section, it is not outstanding amount that is approved by the board. The total amount can be given as loan. So you can't have a current account and say that no, my loan outstanding should not exceed, etc. Earlier days, or even during these days, some of the companies actually use and say that they keep funding the subsidiary and the money will come back again, go back, and come back, etc. And they look at only the closing balance to see the provisions whether it is exceeded, but which is not to be done. It should be looked at the total amount advanced, right? That's how the limit need to be seen. Of course, limit can be revised through a special resolution again by the members, but this is one, how do I say, one mistake commonly done by some of the company. They just look at the closing balance. They don't look at really the actual amount paid. Second question comes to see. Second question comes because 186 actually covers about you need to charge the interest rate, etc. So second question is, can I really charge the interest rate? Actually, wholly owned subsidiary. I mean, if you look at other way around, right? Wholly owned subsidiary is integral to the parent, right? There is no other external party involved. So it is my own business, even though it is a separate company, and any gain in that investment is wholly to the parent. There are no minority shareholder, etc. So, and whatever money I invest, I mean, unless it is used for any other purpose, it is invested for the benefit of that business, which will indirectly benefit the parent because then my investment value will go up, etc. So that way, this is generally considered as no interest to be charged, which is allowed. So interest-free loan is permissible to the wholly owned subsidiary. I am reiterating, it is only for the wholly owned subsidiary. If it is, for example, even if it is only owned by 99%, still applicable. But if it is only fully wholly owned, then interest-free is permissible, right? Now there are situations where we may have a subsidiary sitting outside India. So if it is subsidiary sitting outside India, but it is still wholly owned, right? I mean, you can have a subsidiary outside India wholly owned. And now considering it's a globalization, many of our companies in India have wholly owned subsidiaries outside India. Can we give interest-free loan to wholly owned subsidiary outside India? As per Companies Act, still permissible, but you get into the arm's length of the Transactional Income Tax Act, wherein industry loans are not permissible to an outside party, right? You need to benchmark what is the rate available to the foreign entity. So industry loan to an subsidiary outside India is not permitted because, and we need to be also clear, right? So we have a CARO reporting where we need to confirm that the transaction between the entities are at arm's length. So if, for example, interest is not charged for a wholly owned subsidiary loan, then it is not at arm's length. Even if the management believes that no, I have 185 exemption and all that, right? But it is not at arm's length. So arm's length is again covered under our reporting as well as other sections wherein mandatory. So need to be reported. So we need to be careful this one piece because at times people argue that this is not, they've already exempted wholly owned subsidiary whether it is India or outside India. But if it is outside India, cannot be given as an interest-free loan. So now one is wholly owned subsidiary, right? Now, what are the other category? I mean, as I said, it can be an associate. Still, we have significant stake there. Maybe up to 49% is considered, even up to 50% also considered as associate, right? For example, if you're an Ind AS, under the Ind AS framework, there could be situation where both, I mean, it could be a joint venture. Even if it is one party holds more than 50%, also at times it is considered as joint control, right? It may not be a subsidiary. So even those cases, maybe the parent will send money to them for their furtherance, but they will not call under wholly owned subsidiary category. Then they will come to the subsidiary category, right? So, and we want to give loans beyond a particular limit. Now we'll come back to the special resolution mode. So special resolution, if it is taking through a special resolution, we can give a loan beyond the limits as well, right? Limits is what? 100% of the share capital plus, sorry, 100% of the free reserve or 60% of the paid capital for free reserve, right? So, but through a special resolution, we can actually give more loans. Only thing is this notice to the general meeting, and this is more of a documentation, but if it is a large number of shareholders, etc., large number means not like a listed company, even if it's an unlisted company with maybe 100 shareholders at times or 200 shareholders at times, etc. Ensure that this notice goes with full details, right? Full particulars should be there. Full particulars means everything, right? Including the repayment terms, interest rate, is there a security, what is the installment due, what time, etc. So it need to be a little detailed and what is the purpose for which is given, etc. And this notice to be part of the, if we have any situation like this, we should ensure that this notice actually gone and we have cited those notices as well. Similar provision which we've seen in the normal wholly owned subsidiary case, you can't give any loan to anybody other than its principal base of business activity. So you can't give to a promoter entity to buy a flat. You can't give a promoter entity to go for their international trip. You can't give a loan to a promoter entity to do anything else, right? So this is not to be given. If the principal activity of that company is to do what? Trading, then for the purpose of trading or some working capital requirement you can give. That money should not be utilized for any other activity. This is the responsibility of the auditor to see as well. Of course, management first responsibility lies with the management, but we need to have this documentation when we look at it, kind of thing. Yeah, so we discussed right in the earlier slide what is an ordinary course of business. ordinary course of business is purely an ordinary course. It can't have anything extra. For example, you can't have a differential interest rate. You can't have any undue favor or different terms of loan, sorry, terms of repayment. So anything which is undue advantage to the borrower, all right, then it is not considered as ordinary course. So we need to be very careful if somebody argues that boss, this is my ordinary. So because ordinary course of business, there are certain exceptions to infrastructure companies, etc. available, right? If you're an infrastructure company, you can, it is ordinary course of business, you lend, it is considered as allowed. But then need to be very careful. We have ticked off this ordinary course in the real ordinary course scenario. Okay. Yeah, so another exemption again. So as I mean, from the beginning we started, right? We have generally prohibited. We looked at first scenario, wholly owned subsidiary, then the second scenario, other subsidiaries and other parties. Now, another exemption is given as per the act is that loan given to a managing director or a whole-time director. So it is not, I mean, if you look at the loans from the other section, right, from the deposit rule, loan from is given as loan from a director. It doesn't say managing director or a whole-time director. But loan given to, they clearly say that it should be a whole-time director, or incidentally, managing director is also already a whole-time director. So loan cannot be given to any other director. So he should be a full-time employee of the company. So you can't, for example, you have 10 directors, only one guy running the show. The loan cannot be given to the other 9 guys. Only the managing director or the whole-time director is eligible for the loan. So unlike the other deposit section where company can accept loan from anybody, right? Now, of course, loan can be given to the managing director if there is a requirement, or a whole-time director. But since he's a whole-time director, managing director, he should not have any advantageous position. This should be in line with loans given to the other employees as well. For example, see, what is the loan generally given? You can give a vehicle loan, right, which is available to most of the employees in that cadre of level 1 or C3, whatever you call. So if there is a vehicle loan available to that kind of employees, you can give the loan to the managing director. If there is a salary advance for a period of 36 months, which is available to all not all employees, that category of employee, then it is considered as available to him. There could not be any special, how do I say, special benefit to the managing director or a whole-time director. If it is given, then it is not exempted, right? So we should be careful if there is any loan given. Yeah. Now, so 185, I mean, now if you look back in 185, exemptions are very limited, right? I mean, if you, in the deposit side, if you see, there are quite a few exemptions because they said, again, the next section started with that, right? Any money received is considered as deposits unless it is excluded. Because of that, there are quite a few exceptions they given, but here it is only loan, right? I mean, so this side it is only loan or in the nature of loans, right? So loan, there are very few exemptions. Either it should be a wholly owned subsidiary or through a resolution, special resolution. And as I said, you can't give loan to, I mean, it is allowed through resolution to give any loan to anybody, right? If it is not related, etc. But as an auditor, we should have that skeptical mind in our auditing. If any loan given to anybody for that matter, right? And there are smart people, right? They will give loan maybe 2nd April, and there will be quite a few transactions. And 30th March, everything will be closed. So 31st March, there won't be anything. So then as an auditor, you may end up not even noticing that there are such loans in the company. And this is all happening, right? There are people who actually transfer fund during the period and squaring it off at the end of the year, etc. So those are the items. As an auditor, we should be very careful. Now, so 185, I kind of told. Now, 186 is the section where investments also covered, right? Loans is one section of loans is covered under 185. 186 primarily covers investments as well as how much you can give. The limits, etc., kind of covered in 186. So investment, I mean, if you are in a large group, and I mean, this is a very hot topic in India, right? I mean, people invest outside India through multiple layers. For example, the money will go from here to Mauritius. From Mauritius, it will go to Dubai. There is a free zone there. From Dubai, it will go to multiple other countries. So and you have other jurisdiction like BVI, etc. Right? So a lot of people use these structures to transfer money outside India. So and finally, we don't know where this money actually went, right? And if you see the FEMA regulation, also you need to file a ODI form plus the annual APR, etc. But still, it was very difficult to figure out where this money ultimately went. So then the MCA come back and told us you can't have multiple layers to invest into a company. You can have only 2 layers. For example, parent plus 2 layers. After that, it should be the ultimate investment. You can't have 7 layers, 8 layers, which was there. I mean, we may think that where are these what are these companies? But really, there were companies who were doing 5 layers, 6 layers to ultimately transfer the money, right? So they said no, unless it is requirement of the law in those places. Strictly, it is not allowed to give investments in multiple layers. So that is 185, the first section. Now, second is, again, as I said, loans or even investment. Whatever amount loan put together, loan, investment, guarantee, security, all put together, there's a limit is given, right? Beyond that, you can't give. Because then what is the purpose? For example, a company with a 10 crore giving a loan of 50 crore or a guarantee of 50 crore, then is it a real business? Then are they into lending business? So they said, when you can't give those loans, and loans include everything, right? Loans is not to loans to a related party. It can be anything. Loan to wholly owned subsidiary, loan to employees, loan to managing director. So all loans and investment put together, they said there is a limit. So one is 60%. 60% is paid up share capital and free reserve. Free reserve includes security premium, so I'm not calling out. Or whichever is higher, right? Or 100% of the free reserve. If your paid up capital is very small number, then 100% of the free reserve and security premium. That's how the section reads. And free reserve, we need to be careful. Don't look at the entire retained earnings. At times, there are amounts sitting in retained earnings, including revaluation reserve. And if any of you are doing an Ind AS company, now it is Ind AS is there for a long time. When you do an Ind AS transition, right? If you're doing a revaluation of land and building on the transition date, it go and sit in the retained earnings. So if you look at as of today, if you read that balance sheet, you don't even know retained earnings includes a revaluation reserve, right? Because revaluation reserve is not shown separately under Ind AS statement of changes in equity. So, but Indian GAAP, we still have that separate particulars, right? Revaluation reserve, etc. But in AS companies, we need to be very careful. This revaluation would have done maybe 5-6 years back. They're taken into retained earnings, and when we compare to this list, the limits, those amounts should be excluded. That's expectations. Or for that matter, even Ind AS allows if you have a foreign subsidiary, etc., unrealized forex as on the date of transition to retained earnings, right? So those are not allowed. So need to be taken it out when you compute free reserve. So free reserve, and if you get into any such situation where there's an Ind AS company and there are loan given, etc., this is one thing we should have in mind while computing the limits. As I said, this limits includes everything, right? The loan given to subsidiaries also comes under limits computation, but subsidiary, anything wholly owned subsidiary anyway, we can give number, any amount, but when you compute the limits, even that amount need to be included. Disclosures need to be very detailed, which anyway I'll cover a little more in the subsequent slide. But yeah, so see, both when deposits, as I said, unless it is a real deposit, we need not have too much of disclosures. But many companies have these loans. Even if it is closed during the year, these disclosures should be there, right? So disclosures need to be given. Now it is 186.5, subsection 5 says that, I mean, don't take it, I mean, of course, small companies, board is a small board, etc., but don't take it lightly. For example, we may doing a company where board is constituted, I mean, or convened only on quarterly basis, right? The section says that no loan should be given. No loan should be given without the approval of all without approval of directors. And they're saying that all the directors present in that meeting. For example, some company, we had instances, I mean, to be fair, right? There are companies where there is a minority shareholder. He's also a director in that company. When this resolution came up, he said, no, we can't, I'm not ready to approve this kind of thing, right? Then it is stuck. So then the board cannot approve that because the section says that all the directors present in that meeting. See, quorum, etc. is a different thing. But if the director is present and he is giving a no to that resolution, then of course shareholders can overrule. But then this is considered as invalid. Second, of course, I mean, if there is a public financial institutions, etc., term loan is there, you need to go for a prior approval. But this section, without board approval, there should not be any loan or investment. Subsequent ratification will work. As per the section, no. And if you read through this section along with our guidance note, right? Guidance note, because there's a requirement for us to report under 185, 186 compliances, including whether it is prejudicial to the rights of the company, etc. So that way, if you read Caro guidance note along with this section, prior approval is mandatory even from a board perspective. So if there are no prior board approval, but immediately some funding has to be done, they given the funding, we came back and came to know at the year end what is our obligation. As per the Caro, we need to call out that it is prejudicial, but maybe give a statement of fact in the report as well as in the financial statement saying that this has been subsequently ratified by the board. All right, but this is one mistake we keep happening with the company, because there is a sudden requirement came out of the group company. So the promoter or the director say that, okay, you transfer 10 lakhs to that company. Board anyway, I'll tell the board, etc. And board meeting के लिए second director is not available in India, or he or she is traveling. But this is something we need to be careful. The section reads as well as the Caro guidance will say that the approval should be prior. And wholly owned subsidiary is the only place where loan should not have any interest. Any other loan, whether it is related, unrelated, and you given loan, it need to be with the interest rate. And interest rate, again, they given the period. For example, if you are given a 1 year loan, then 1 year government security, that's a benchmark, right? Only thing we should be careful. For example, giving a loan to another entity, right, without any security. So what is this prevailing yield of government security, which is end of the day government security, right? Government security is the most secured instrument, at least at this point, available in India. But if the company giving a loan to a third party without any security, any repayment terms, then this rate should not be the rate. From an arm's length perspective, ideally should be slightly higher. What is slightly? But generally people add a percentage higher because there is a risk premium involved. You are giving to somebody without any security, etc. So if you are doing a large company and you have a situation where loan is given and they're saying that no, I use the government security rate, we should read that along with the arm's length of the transaction. There we may fail because that's a secured government security rate. We need to look at an unsecured rate and don't benchmark. And so second thing is how the arm's length will work, right? For example, the lender is a holding company or any company for that matter, gives loans and they have borrowing from outside bank, right? And they take the loan from outside bank at 11%. They cannot say that my government will rate is only 6.5, I'll lend it to them 6.5, which is not an arm's length, right? So if the loan is taken at 11.5, the minimum rate at which they can transfer that lend to other parties is 11.5, or it is 12.5, right? Because as I said, if it's an unsecured borrowing, it need to be 11.5. These are the things people, at times the management taking it very lightly, and they keep arguing that no, boss, this is it. Second argument we commonly see, right? I mean, if I kept this money in FT, I only get 6.5%. I am charging them 7%, etc. But if you have a correspondingly, there is the FTs again with a bank is considered as secured. Of course, there is security up to 5 lakhs, etc. But more secured. So don't just benchmark with a bank FT rate, etc. We need to look at overall that company's source of fund and how much they were earning. Because this, and see, not everybody is I'm saying that crooked or something to divert the money, but some people use this mechanism to transfer money from a cash-rich company to a loss-making company, then divert from there kind of thing. So this is the only place we need to be careful. And here, other thing which is not there in the slide, if the company have any loan from anywhere, right? Any bank or financial institutions, generally there will be a clause saying that intercorporate loans are not allowed without prior approval of the bank or lending institutions. So that is an incremental approval, which is not as per Companies Act, but that anyway, before giving any such loan, we need to be careful. And it is general. So normally any standard sanction letter will have this clause. At times we only look at Companies Act compliance and say that no, everything is fine, so we can give loan to the other company. But look at the loan agreement as well. There could be clauses where say that if they want to give any loan to another company or a related entity, they need to take prior approval of that lender. So which is another thing should keep in mind. Now, see, listed companies, I'm not touching it because Companies Act has this thing. Listed company have LODR requirement little more rigorous. This slide I brought it because there are some resemblance of the requirement in under company, because Companies Act not give very detailed, but look at the requirement which a listed company or subsidiary given. This is the expectation the company need, expectation of the regulator that a company need to give or submit to the shareholders or a directors or audit committee the documentation if you are giving a loan, right? One is the source of fund. Source of fund, I told you, right? It could be, I mean, it should not be a loan you take and then you invest, etc. Now, because of this, do you have any financial indebtedness? So the document which is to be analyzed by the board of directors as well as shareholders should be little more detailed, even though you may find it as it is applicable for the listed company, but equally to approve for a shareholder all these items, for example, governance, tenor, interest rate, repayment, secured, unsecured, and if it is secured, right? If it is secured, nature of security, etc., etc. So this is something, even though it look like applicable only to the listed company, but this is the most good corporate governance should have. And we should, even if it's a large company with significant borrowings or external investor, this is something what we should request the management to have if they intended to do any approvals either through the board or to the shareholders, etc. This I am little emphasizing because in the beginning I told you these loans are actually people use it for many purposes. This particular thing, even though not very specifically called out in the sections of the Companies Act, but at least LODR is very clear. Right? If you look at listing regulation, this is something which good corporate governance should do is mention the fact that who is ultimate beneficiary. We are giving it to a wholly owned subsidiary, or we are giving it to the associate. We are giving it to a subsidiary, or an independent party. They are the guys who are going to ultimately use this, or it has been further funded down, etc. I mean, you would have seen the Island of Us triangle, right? There are hundreds of entities where through this loan is gone, and it finally people couldn't even figure out which entity has finally benefited this money. So ultimate beneficiary is something should be very, very important, very, very important to be documented. Now come back to documentation, right? Documentation for the company as well as auditor. As I said, we do a lot of private limited companies, public companies. I mean, as I said, 19 lakh companies in India. Unless they take out this mandatory auditing, which is some discussion still going on, but we would be keep signing these 19 lakh to 20 lakh companies every year. And important for us to have documentation in place. From a company perspective, as I said, the section is actually saying that both lender as well as borrower is liable to keep documentation, because utilization is the borrower's responsibility, and borrower should submit that. And lender responsibility is what? Lender responsibility is to collect that confirmation from the borrower saying that they used it for the principal activities, right? Principal business activities. So this utilization certificate is something both borrower and lender need to be careful. Second, the resolutions And for example, if it is investments, etc., anyway, MJT 14 is to be filed with ROC. So the resolutions is mandatory, and extract of these resolutions, if you are an auditor, should be in the auditor's file, extract of this resolution, because that is the most important document to say that they complied with all these provisions. And this extract of resolution, when you take it up, as I said in the previous previous slide, it should ideally have those parameters, right? Why it is given, whether it is for the principal activities, what are the rate of interest, all that should be part of that resolutions. Now come back to the disclosure, right? What are the disclosures? Whether it is loan given, need to have mandatory disclosure. One is, of course, I mean, which is Schedule 3, the requirement is that current versus non-current. The loan is given for a period of 1 year or beyond, then the current versus non-current classification. At times, generally we say that the lender has the right to recall this loan at any point. For example, we are giving a loan to a subsidiary and we say that this loan is repayable on demand. Demand means, I mean, the lender, the holding company has the right to recall at any point in time. And because of right to recall any point in time, then the lender says that it is a current asset for me. But the subsidiary or other company, they were actually thinking that no, this loan is given by the parent, and parent is giving me a loan generally for a period of more than 1 year, because whenever the parent loan is generally repaid only after other borrowings are repaid, right? And the subsidiary believes that no, I have other borrowings to repay. My term loan is spending, my working capital is spending to be repaid, so I cannot repay. So that they will reclassify into non-current liability. So there is a mismatch. So you can't have that kind of situation. And incidentally, if you are auditing both subsidiary and parent, generally this classification should not be different. If it is intended to be collected within 1 year, it should be current assets. But the parent also knows that they will not be able to collect within 1 year, because that's how the subsidiary running, right? They are loss making, or the associate is a loss making entity. They will not be able to take the money within 1 year. Then it will go to non-current loans and advances. Why non-current? Current, because your current ratio, etc., will get impacted because of that, right? Of course, the repayment. See, even if it is repayable on demand without any interest, if it is wholly owned subsidiary, in the financial should have that normal sentence, right? Loan repayable on demand, or interest-free loan repayable on demand. That's mandatory. It is unsecured, right? All this should be there in the finance statement. You don't need to give a schedule, etc., but at least say that unsecured loan repayable on demand, etc., right? Now come back to our reporting. Reporting is very wide. I mean, if you end up, of course, any laws and regulation, if there is a non-compliance, and it is significant, right? The main body report attracts that, even if it is a CARO is not applicable, because if there is a violation, then there is a violation, and we believe some of these violations are very material. For example, loan is given, we are unable to figure out where this loan now sitting, where it is correctly approved, or whether this is given at a correct way, etc., etc. And we, of course, it is the main body qualification. But now come back to that I believe maybe the rarest of the situation. But CARO reporting, there are multiple clauses, right? So when you look at it, it is given actually a very wide task to the auditor. They just say that whether the company has complied with section 185 and 186. And 185 and 186 we saw there are quite a few compliances applicable. So we need to be very careful. I mean, they are actually complied with all these provisions. And every year when the auditor need to report, the loans given for that year is what we look at the compliances. For example, if there is a loan which is already given in the previous year and which is already non-compliant, the statement of fact should come, but the starting point is any loan given during the year, right? And for example, the other way to look at it, if already a loan is complied in the last year, and subsequently when another loan is given, it is not complied during the year, then that fact also should come out, right? So it includes everything, right? It includes guarantees. I mean, if you go read through the CARO, it is easily figured out. I told you the prejudicial to the interest of the company. What could be prejudicial? One is you given an undue interest rate. For example, generally it should have been charged at 12%, but charged at 6%. That is prejudicial to the interest of the company. Or the board supposed to, I mean, I told you 186.5. So if the board is not approved, and actually the guidance note actually called out and say that we should mention the fact that it is prejudicial because the board is not approved but given the loan, even though it is subsequently ratified. But bring out the fact the board is approved on so and so date and subsequently it has been ratified, etc. Now a loan is given for a period of 1 year. It is keep extending, right? They say that no, another 1 year, another 1 year. So does it really then coming back? Is it not prejudicial to because see, the company which is giving loan, whether it is holding company or any other company for that matter, how requirement of the cash, right? So then that is prejudicial to the interest of the company. So the so-called evergreening, right? Or the money came in just before the repayment due date, then immediately given back after 2 days. All these are we need to be very careful, and these are happening. It's not like a how do I say? It's a story or a example which we have. This are happening in real life situations. So those are need to be considered prejudicial to the interest of the company. But next question is, since we call out prejudicial to the interest of the company in Caro, then will have any impact on the main body report? Generally, no, right? Unless it is a very material number. For example, interest is charged at 6% against 9%. Whether 3% is so material to the overall true and fair? Generally, no, unless it is a very large number. So we will still avoid calling them calling out as a qualification in the main body, but it will continue to be a statement of fact in the Caro reporting. All right. Of course, the Caro has other reporting requirements. So this particular section, I mean, of course, deposits have the clause number 5, but this clause number 3 and sub clauses towards the remaining clause till it is quite a few reporting requirement for the auditor and for the company as well. And at the beginning, when the introduction told liability for the company is there, which is monetary liability, but this section actually called out liability to the director, right? To the director, it is not only monetary penalty. There is an imprisonment which is even there from a director perspective. So there are personal obligation, and when we are doing an MNC company, etc., some of these they may think that it is allowed in Indian scenario because their country it may be allowed. For example, if the director is an NRI and he based in Dubai and they're giving money to each individual entity is nothing, right? They just give loan, no regulation assets. So they think that this is okay in India. And at times they will also think that no, even if there's a penalty, I'll pay 50,000 rupees and move on. But actually it is not. I mean, it doesn't mean that in India a lot of such things happening. But there is a personal penalty. See, once you have penalty like imprisonment, automatically you need to vacate as a director, etc. You will be disqualified as a director. So need to be careful on these sections. Primarily, these are the things I wanted to cover. Yeah. So otherwise, happy to have any questions. I think we have another 20 minutes to have any questions. Srinivas, I can take out my PPT and maybe.
Yes, I think in case participants have any queries, they can perhaps write it in the chat box, or I think the organizers should be able to unmute them so that they can pose the queries.
Yeah, or anybody want to share any real life challenges, examples?
Sir, may I ask one thing that came to my mind when you were
Yes, please. Yes, please.
one of the aspects that we all come across is loans from directors and shareholders. Of course, the conditions are there that it should not be from borrowed funds, etc. But I've always thought, how long can it remain in the balance sheet as it is, unsecured, maybe without any interest? Director has ceased to become a director, but the loan continues. How long can it remain like that? As an auditor, what is it that I should I look beyond just what the company has shown to me as compliance documents, or what should be the perspective?
Yeah, this happens, right? We end up seeing such example on many occasions. But I'm looking from the company side first. Company side, if you look at it, I collected this money and it is allowed under the act. Instead of that, if I could have gone back to a bank, etc., I would have paid interest for that matter. So from a company's perspective, it is okay to continue, right? I mean, unless and it is allowed under the regulation as well, because company is not paying out to anybody else. So if it is taken from a third party, so I mean, if you look at that, your return on investment is higher in those cases because you're saving the interest. So I would rather say that if it is accepted or collected by the company, it can be considered okay. I mean, unless there is a repayment is requested and we couldn't pay.
Okay. What about the global, let us take the scenario of multinational companies where there are, associate companies across the globe, and there may be global internal funding strategies followed in different ways. And whether, have you ever, as an auditor, come across a situation where the global practices are not don't fit into our compliance regime, in the sense our compliances go against the global funding strategies within the group companies? How do we, as an auditor, reconcile between because when we discuss section 73, 76, 185, 186, they are all restricted to our Companies Act. How do we reconcile this difference when it comes to when we do audits in that scenario?
Okay. No, it's a good question. So when you speak to some of the global directors, this comes up. But in the developed countries, our restrictions are more or less similar there, right? I mean, because they follow a similar structure. For example, if you go to UK or a US cap kind of requirement, or US Companies Act or UK Companies Act requirement, primarily they are in line with our requirement. But for example, if you're in a Gulf nation, all right, and that is where or in a Singapore or a Mauritius kind of directors, that is where we kind of really struggle, because their regulations are very easier. To give fund between group companies, there is no such restriction, right? And if one promoter, he has multiple companies, he move the fund between the companies whenever there is a requirement. So those jurisdiction, when you interact with them, that is where actually we get stuck as well. We need to tell them, sir, this is the provision, this is where you would go. So I mean, I recently had two ladies from, I think, Australia. They wanted to set up a company in India. They came back with similar proposal. They can send money from there through their directors. Then we need to tell them, ma'am, this is the requirement in India. You have certain restriction. But at least developed jurisdictions still have that maturity to accept that India has thing. But some of this, less restricted regulatory environment is a challenging for us.
Understood, sir. Understood. We have a few queries that had come up in the chat box as you were doing the presentations. Maybe I can read out them for you. One was a query from CA Saumya. She has asked, what if the sale agreement period completed, but sale has not happened due to fault from the buyer or any technical reasons? Perhaps she's referring to the exemptions that we have in case of
I think he's referring. Okay. So this is very common, right? I mean, so I actually given you that example, and this vehicle dealership, if you are an auditor of a vehicle dealership, of any vehicle for that matter, whether it is two-wheeler, three-wheeler, or four-wheeler, even for that, people give some small token amount to book the vehicle, later they to come back. So the argument of the company is that, no, they are not came back to collect that 10,000 rupees or 1,000 rupees, right? So how can be a deposit for me? But the act is not giving any exemptions, right? Even if the buyer is not able to take out, it is our responsibility. See, now KYC is mandatory for everybody, right? To take when you collect money from any customer, minimum KYC. It should have been come through a bank account. Somebody dumped you a cash bundle and you couldn't manage it, then there's a different matter. But if it come through a banking channel, the company which is receiving this advances should take adequate steps to reach out to that customer to refund the money. All right. It doesn't mean that you need to refund this thing, but at least there should be adequate step taken by the company to refund the money. Otherwise, it is considered as deposit, and that is where I was told that if the management argues that no deposit, you at least bring out the fact in the Caro close file saying that there are certain balances outstanding for a period of more than 1 year because of so and so reason, and management believes these are not kind of thing. I think the auditor need to bring out the fact. That's where I will leave this. There are no other way we can close this.
Right. Jay has asked a question. What kind of amounts received from employees is in the nature of non-interest securities? What kind of amounts received from employees is in the nature of non-interest securities? Interest.
Yeah. So this is again, yeah, I think I mentioned about, yeah, if that's for the employment contract. So what can be received, for example, generally a company which have accommodation to the staff, they may take a caution deposit, right? Which is as per the employment contract itself, you don't pay any interest for that, right? So the caution deposit of 5,000 being collected as per the employment contract, and this will be repaid when the employee terminated or employee resigned. So there won't be any interest. Those are exempted from the deposit rules.
Yes, thank you. I think CA Soumya has more to ask you. May I ask the organizers to unmute CA Soumya, or is she allowed to unmute herself and ask the query? CA Soumya, I think you can try to unmute yourself and
Sir, good evening, sir.
yeah. I think you can please ask your, you can discuss your.
Sir, as you said, for management things, it is a deposit. We can mention in our report that management is treating the same as not a deposit. So, is
You
there
are
any obligation from the auditor that we need to conflict with the management decision and report somewhere in our audit report that we are treating it as a deposit, but our management is not agreeing with our terms? So,
Yeah, so it's a good question. That's where I think we had this obligation under clause 5 of CARO. If CARO not applicable and the amount is material, then bring out the fact. See, how do we do? One is, as an auditor, we know these provisions and we believe deposit rules are applicable. And for us, it is clear that it is a deposit, then we need to qualify, all right? Second way to look at, there are some gray, and management has taken enough steps to repay, but they couldn't reach out the customer, and they've shown us the evidence saying that we had tried to repay this money. Or there are some small amount which is accumulated, very small amount, and management is reviewing every periodically, and if it is not repaid, they're writing it back. I mean, they have a policy to do that, etc. So we need to use some professional judgment, but end of the day, then we come into a situation where certain amount has not repaid and still is a deposit. Management are arguing not deposit, but we believe it is a deposit. And it is material. We have an obligation to report. If CARO applicable, then go to clause 5 and bring out the fact that company has this amount outstanding. And if it is no CARO applicable and we are already left with the main body report, and it is a material number which will impact this thing, then bring out as a qualification. But if you believe it's a gray area, very small, I mean, the numbers are not overall material, then at least bring us an EOM or a other matter kind of thing to the reader.
okay. Thank you, sir.
Thank you.
Yeah, I think as we come to the close of the session, one thing is very clear: deposits and loans are not just compliance provisions. They are the auditors' reporting provisions in real life. So that's something which the auditors have to really look into very seriously. I think today's discussion has helped us clearly understand how these sections 73, 76, 185, 186 actually translate into auditors' responsibilities, especially in connection with the speaker was clearly mentioning about the CARO reporting aspects where, even though it might not be a qualification per se, it may not be a negative remark per se, but then disclosure of facts in the CARO, the statement of facts is also extremely important. Over and above the disclosure in the financial statements, and also evaluating the management's representations and taking due consideration of what the management looks at the loans or deposit like is also an important for the auditor to evaluate. I think a very important takeaway from today's session was the clarity around exclusions. I think beautifully explained, because in practice, most audit issues arise not from core violations but from incorrect assumptions about what is excluded. So one presumes one to be excluded, but is actually not.
Right.
That was a very good, you have categorized it very well so that we are able to remember these facts very clearly. I think the session was especially valuable for those of us who are handling audit of small and medium companies where documentations may be minimal. Sometimes, as you were mentioning, the directors may presume that they can always convince the board and get some kind of a paper to convince the auditors, but later they realize it can't actually happen. So the margin of error is very small and the consequences quite serious and significant. From an audit standpoint, I think the discussion has reinforced proper identification, classification of transaction, reporting, disclosures, the requirement of necessary approvals, documentation, clear audit trail to support the observations in the Caro and as an auditor in general. I think we must, on behalf of the organizers as well as all the participants here, I think let me just see if there is any more questions in the chat box before I propose my vote of thanks. I think there is one query as to what is the limit of borrowing by a company from its director, what are the applicable provisions and its practical difficulties in implementing the same. A company is providing intermediary service. I think that might be a different question. Sir, maybe sir, you may
Yeah,
also
so I
look
think
at the chat
we
box.
touched we touched the private companies are allowed to take loans, right? We have the limits is given 181C for the board to take loans up to 100%, etc. But beyond that, shareholders can of course take approval. So if it is a pure private company, limits is set by the board as well as the shareholders. But if it is a public company, then you get into the limitations, etc. Including, and if you have a borrowing from a public financial institution or a bank, then you get into this. But generally, a private company, the board and shareholders can actually move. Right now, there are quite a few questions coming now. Sorry, this is somebody releasing. It seems to be. What are the application portion and practical difficulty? Yeah, practical difficulty. I would have already mentioned in my sessions, right? Company for intermediary services, company collecting and keeping security deposit students and keeping it on behalf of the education institution. Companies are receiving revenue. Income without security deposit will be considered as deposit. Yeah. So this is yeah, that's a good question actually. This is if you are collecting money from a student and that student is registered for a course for a period of 3 years and that period is not completed, that caution deposit can be continued for the period of the course, which is allowed. Why does the act is adopt a substance over form of process determining whether the transaction cost? Yeah, substance over form, substance over form. At least the regulation is very difficult, right? I mean, regulation generally, unless it is black and white in regulation, people take it for granted. So substance over form is very, very difficult in a regulation. I mean, of course, in other cases it could be, but substance over form is generally not allowed in a regulation. A lot of limits. How do we renew? It's coming like somebody is releasing the question now. A lot of times with experiment tools and trials are conducted in browser such as from customers outside India. So outside India, as I mentioned, outside India, the advance is actually outside the ambit of deposit rules, right? Then we'll fall back to the FEMA regulation. That's where I mentioned up to 1 year if it is outstanding, it is just a trade advance. 1 to 3 years, and if it is going beyond 1 year's current regulation, I'm saying there's a new regulation coming from 1st October, but current regulation saying up to 1 to 3 years, you need to intimate our AD bank saying that we collected so much of money. We couldn't because of the things are still in progress. But beyond 3 years, if it is still outstanding, then you are into a problem getting into RBI approvals, etc., etc. I don't think we'll be able to take all questions.
I think, sir, you can be selective. You can take the most relevant.
Yeah, because that is substance of form was textual hormones. Yeah, one or two. Yeah, so one or two common one. One or two common ones here. So repeated short-term loans, as I said, you should look at the limits. Limits when you compute, it is not outstanding balance, the total loan given. So you should have a limit which is totally covering the entire loan. Yeah, share application money, I briefly mentioned. The money received within 60 days should be allotted. From there, another 15 days to refund. So totally 75 days, otherwise the deposits. Yeah, so this is a good one. So I mean, ROC inspections and how they look at deposit rules, right? I mean, I think I had a chance to have another session with an ROC maybe a few months back. So ROC, see, if it is small thing, I don't think ROC these days is penalizing anybody. But people using it as a scheme to collect money, that is where ROC coming into picture. For example, people use schemes, right? Schemes means collecting money as a scheme, right? They will say that if you pay for me 10 months, I'll pay you for 12 months. All that schemes is where ROC looking at in more seriously. But from a company perspective, as I said, it's black and white, whether it is a deposit or not. But ROC may be looking at, I mean, they can't get into every single thing. That's where I think they are requesting the auditor or a company secretary to certify all of this. I think advance, a lot of question, I kind of covered it. Advance is a common thing, right?
I think
yeah,
most
so-
of these
yeah,
issues
most
were
of it is
covered
covered.
by and large, yeah.
Yeah, compliance section to regulate launch contracts. Okay. Yeah, I think most of it is, yeah. So see, I mean, differences, I don't know. So the last question I may cover, 185, 186 is loans given, 73 to 76 is loans taken, right? Very clearly. So these are the two different sections altogether. Loans taken, so the amount taken is, as I said, you need to look at all balance liability side of the balance sheet and see what is excluded. But loans given, you look at the loans and investment, that particular section alone. Yeah, that's it primarily. I think we kind of answered most of it. Yeah, it's Srinivas. Yeah.
Yes. Thank you so much, sir, for patiently reading through and answering those questions. On behalf of the organizers and all the participants attending, I extend a sincere thanks to CA Baby Paul for giving us a very, very insightful session, methodically breaking down a complex subject, clearly explaining the practical applicabilities, exclusions, etc., and also giving a strong emphasis on audit reporting and CARO compliances. I think that should be the highlight, according to me. The session has undoubtedly added practical clarity and audit confidence in the professionals, I'm sure, dealing with, especially, in case of audit of corporates, closely held corporates with many group companies. I also thank all the members for their active participation and attention. I think most of you have been glued to the session till the very end. Thank you very much. With that, we formally conclude today's session. Thank you, and wishing everyone a very happy evening. Over to the organizers. Thank you very much. Back to the organizers.
Before the organizer, thank you all for the patient hearing, and thank you, Srinivas. I mean, you actually set up very well in the beginning, concluded it very well, and it's very important setup and conclusion. And thank you for that.
Thank you so much, sir. Thank you so much.
And of course to the organizers for bringing me in and the team. Sorry, anybody from the organization team?
Thank you, sir. Thank you for addressing those queries so comprehensively and for sharing your valuable insights. I extend my sincere gratitude to all our distinguished speakers for sharing such insightful perspective on deposit and loans under Companies Act. And your expertise has truly enriched our understanding of the important legislation. We also thank all the participants of joining us and actively engaging in today's webinar. Your presence and enthusiasm greatly contributed to the success of this session. So we remain committed to bringing more such insightful knowledge, and we look forward for your continued support and participation. Thank you, sir. Thank you once again.
Thank you. Thank you all. Bye-bye. Have a nice evening.